Ah, okay. My apologies. I'll start over. Man, I always triple check it, so I
You're a
almost blew
smart
it. Okay.
man.
Hey there, 10-minute traders. Welcome back to today's episode. I am actually really excited because I get to have two of my friends on the line today, Gregg Gossett and Steve Burns. Both of them have been monumental to me in my trading career, and I am so excited to have them on for our very first Traders Roundtable. Steve and Greg, thank you so much for coming on the line today, and I'm going to let Steve take the floor first and introduce himself.
Great to be talking with you today. Two of my favorite people, Greg and Chris. Uh, I run a New Trader U, and I'm popular on Twitter at sjoseph_burns, and I'm just here to share some interesting information with everybody today.
Hey, my name is Gregg Gossett. I've been a full-time trader for the last 24 years, and I'm excited to be here. Chris and Steve are two of my favorite people, and it's really an honor to be able to be in a roundtable with the two of you. I have a YouTube channel, Gossett Trading and Mentoring Live, where I trade and teach and mentor during the last hour of the market, and at Gossett Trading on Twitter. So I'm really glad to be here. Thanks for inviting me.
Oh, this is great, guys. And for your audiences who haven't had a chance to follow me, my name is Christopher Ewell. I've been trading since 2009, but I'm a full-time financial professional. I have been working in the finance field since probably the worst time in history to start working in the finance field, which is in 2008. And it has been quite the journey into going from, corporate finance world into trading and now into content creation and helping other people. And people can reach out to me. My website is 10minutestocktrader.com. And you can follow me on all the social platforms at 10-minute trading. And, real quick, just an aside, I started 10minutestocktrader.com, and it sounds like such a clickbait name, which it kind of was on purpose. But also, like, when I started trading, I only had like 10 minutes a day where I could trade, and I had to do it from my iPad hiding under my desk. So I've run the gamut as far as like the trading career on both ends of how easy and how difficult it can be to do that.
Yeah, everybody has to start somewhere. That's a great story. I don't know how many traders started using the restroom stall during a meeting at their job to trade with on their phone, and hopefully evolve and grow over the years. I was interested today, if you guys wanted to, talk about the new book, The Man Who Solved the Market, about Jim Simmons, and really focusing in on quantitative trading. Yeah, I know Greg has read it. Is that something you'd be interested in hearing about, Chris?
Yes, absolutely. In fact, just this last week, I went on a little Amazon binge order and bought, I think it was 10 or 12 trading books. And one of them was The Man Who Solved the Market. And it's somewhere between the Amazon distribution center and my front door right now. So I haven't read it yet, but I'm interested in the conversation. I think this will be really interesting.
What did you think of the book, Steve?
Yeah, I've read hundreds and hundreds of trading books. I've actually lost count of how many. And I would put it in my top 5. I mean, this is a guy who is so unknown because he's so secretive. And here he is returning over 60% a year since the 90s, and having very tiny drawdowns, great risk reward ratios, and really changed the market by using quantitative edges. One of the first to get the price data in place to be able to trade quantified systems, and then got faster and faster with using technology. It's an amazing story of mathematicians and statisticians and computer scientists beating the market. A lot of things he did were things that were supposed to be impossible before he did it. Sort of gave birth to the quant revolution and high frequency traders.
Yeah, what I took away was just his determination and the tenacity that he had when he was trying to figure it out, and the failures that he had at first. But he really wanted to figure this out, and he got the best people in there, and he did eventually do it, didn't he?
Yeah, he basically is as close to the holy grail as you're going to find in trading, which we all thought was impossible. But one of the most interesting things I saw was he only won about 50% of the time with his firm, and it was like a giant casino playing with an edge he had based on patterns in data of human behaviors and just playing it over and over again thousands of times, not really making any big bets, just making thousands of small bets with about a 50% win rate. But the risk reward ratio is what it seems to me really achieved his profit. So even a Holy Grail system had about a 50% win rate.
So was that because he cut his losses like super quick, or how did that work with the risk to reward being so skewed?
It sounds like from the book that he just used quantified data, if this, then that, like Boolean logic, where he just, he let them play out in the time frames, what it looks like. And the position sizes were so small, I don't think he had to use stop losses per se, but whenever, if he was going to buy the close and sell the open on a Friday to a Monday because that worked out, it looks like he just did that and the results happened. I think his position sizing was one of his edges. He didn't take the giant bets like long-term capital management took, and that blew other people up. His were all diversified, but they were large in position, but diversified in actual what he bought and sold.
That buy on the close and sell at the open. I know that's one of Gregg's things that he does every day. I actually reached out to TrendSpider earlier this week, and I was like, I want to back test this. Is this for real, or is this hocus pocus? And that's beyond their capabilities right now. But yeah, Gregg, I was really thinking about you earlier this week and wanted to back test that system because I know you referenced the Twitter post that went around for a while talking about that.
Yeah, I actually saw that Twitter post from Steve a long time ago, and that's how I started to use it. And that Twitter post and the one that I talk about on my show each day. For brevity's sake, I just use what's on the chart there, the numbers and so forth. I'll just quickly give them to you. But the buy at the open, sell at the close every day since 1993, negative 13.9%. Buy at the close, sell at the open, up until January 2019, you return 634.2%. But Steve actually did his own back test on this. I know he crunched all the numbers, and I think this was up till June. So instead of 1993 to 2019, January 2019 being 634.2%, Steve crunched the numbers from 1993 to June 13th, and it was actually 712.63%. And I can guarantee you it's higher since that number, because I do it every day, and I just know that that's the case. But yeah, it's amazing. I'm really, Steve posting that on Twitter, I decided to give it a shot, and it's been extremely profitable. Just that one approach has been responsible for about 22% of my profits this year. That one single
approach. Man, isn't that crazy though? Like that it's negative 13% versus plus 600%.
Yeah, it shocked me when I actually saw it in the book after Gregg, I posted it. Gregg took it live. It was actually a back test done by Bespoke Invest. Actually did the back test with software. What Gregg's saying, I also just took Excel and downloaded all the price data and did the back test in Excel. Also it affects whether you're going to keep trading it with the same position size or you're going to compound the capital. That causes the compounded growth. You keep the same size account, and you keep growing your trading size as the account grows. It really has different returns if you just do an annualized basis versus a compounding basis for the capital. But in the book, it actually talks about, that's the behavior causes that. Day traders all have to get out by the end of the day to be day traders. So it causes selling pressure, along with people that hate to have overnight risk and people that get afraid going into news events, and they all go to cash, and that causes the selling pressure. And then once all that selling pressure is put on, it has to have a relief for people have nothing to do but to eventually have to buy and get back in. And they also say the amateurs trade in the first hour and they go in and buy, and that also is one thing that drives it up. So it's been fascinating to watch Gregg actually take a quantified back-tested system that somebody did and take it live with capital and trade. It's been fun. Every morning it gaps up, I think about Gregg. And even in my in my trading career, I always thought about all the gap ups that have happened, and you capture every single one of those with that system. And you don't have intraday risk. All you have is overnight risk, And that backtest proves the alpha is created in the overnight markets with the futures. The future traders are already piling in based on news and events, and that leaks over when the stock market opens in the morning. It has to, adjust to what the future traders have already priced in.
Yeah, and I mention this every day, but I mean it's mind blowing to me every day that if you think about it, since 1993, obviously the market's much higher than it was in 1993. But what this backtest shows you is that all of the returns in the S&P since 1993, all of them have come from the prices being bid up in the aftermarket, bid up in the pre-market, and sold into the open. So literally all of our gains since 1993 have come from the after hours and the pre-market. They have not come intraday. I mean, it's fascinating. I say it every day and it still blows me away.
Yeah. Intraday is where the big losses happen, not the big gains. In the long term, it's the overnight risk that creates the gains. That is incredible that even the intraday moves generally, if you buy the open, sell the close, you're not net positive much from all of that for all those years.
Yeah. And like you mentioned, Steve, and in the book it mentioned it's the same principle with the I guess the buying on Friday. People don't want to hold over the weekend. They don't want to take the risk. And then come Monday, nothing bad happens and people have to get back in. So, from close to open or from Friday to Monday, I haven't seen any data actually, but the concept seems the same to me, that people don't want to take the overnight risk. So they get out and they bid it back up in the morning.
I think there was actually a book written, if I remember correctly, by, I think it was Yale Hirsch, the guy that gave birth to the Stock Traders Almanac. They actually had a book called Don't Sell on Mondays. I believe it's one of the biggest things he found was the tendency for the market to rise on Monday. And that was one of the first quantitative things that, the Stock Traders Almanac has all kinds of quantified data, the sell in May and go away phenomenon and all these little days of the weeks. And I think that was something that he had written about. I think it was the 70s, and Don't Sell on Monday is the name of the book. It's pretty fascinating and it's the same thing that they mentioned in the book. I think it's was it Zuckerman that wrote that book, The Man Who Solved the Market, and he actually mentions the Friday to Monday overnight phenomenon.
Yeah. And we're talking about the buy the close, sell the open, or buy the Friday, sell or buy the Friday, sell the Monday. But I mean, we're talking about two approaches. Who knows how many they use? They could use 500 of these or 1,000 of these. And with all the brain power they have on staff and all the computing power they have on staff, I mean, all the correlations, obscure correlations, maybe, hey, it's a Tuesday at 1:00 overtime. This tends to move up if bonds are this and if rough rice is this. I don't know. I mean, I'm just making that up, but all these just obscure correlations that when they data crunch, they can find and exploit those repeatable patterns. I mean, I was mentioning before the show, after I read the book, it really made me feel very unsmart. I can't imagine the brain power and the crunching the number and the data and finding these little gems in there to exploit. It's amazing.
That's actually what I was thinking when y'all are describing it is, is there other data that goes into this, right? Is there a confluence of data points? Like, is it, I know Steve is a huge proponent of the 200-day moving average. Does it only work if it's above the 200-day moving average, or does it work on both sides of it? I don't know, but that was something I was thinking too, because that's how I trade is I need to see X, Y, Z, A, B, and C line up before I'm like, okay, let's do this. So interesting points there.
Yeah, they had the most powerful backtesting and quantified data computers ever created. So I mean, they have the capacity to backtest wherever they want. And they say they use anything that's mathematical. They will input in. It's like some of the greatest mathematicians ever. Most of them award winners. Using every complex mathematical formula they can think of. The things we could think of is stuff like if the VIX has a 10-day, 30-day EMA crossover, then go short the SPY, or things like that are more simple, but what they're using is, all kinds of correlations of currencies and commodities and production numbers and employment numbers and all kinds of things. And with their size, what's fascinating is, when these people act like they never lose on Twitter with their social media with their trading, and they win all the time, they never have any losses. It's funny because if you do that, then you compound into, being a billionaire or a trillionaire if you never lose. And what I found fascinating was Medallion truly was the holy grail. Unlike Bernie Madoff, made it hard to get in. They had to actually give back the money to the investors because they couldn't keep scaling it. It got so big and so many billions. They actually had to they had to first give back all the returns every year to the investors because they couldn't keep compounding at the 40% net of fees rate without getting too big. And then they had to give all the money back and just go to employee only in the Medallion Fund.
Yeah.
And I mean, that really shows you, if you have the Holy Grail, you will compound to where you will become the market. So you can't keep compounding capital. There's a limit to how much the market can bear, and you will become the market and start creating the move. So that was another fascinating point that I got out of it.
Yeah, me too. And I think, a takeaway there, a little off the subject, but, as individual retail traders, we have such an edge because the capital that we're putting at work, it's very easy. It goes through their minds. Oh, we're too big. We're going to change the market, move the market. But as individual traders, I think that's one of the biggest advantages that we have. We don't move the market. We can just get in and out just as quickly as we need to without a lot of slippage.
Especially with futures or stocks, it's not an issue. The only thing I've ever had issue with liquidity is in options, getting into options chains or even some really small cap stocks with some size. But, 99% of the time, we don't have any issues with that, especially with the stock market and futures market. I thought another great takeaway from the book was when Jim Simmons had originally invested in Bernie Madoff, but took the money back out because he was suspicious at the steadiness of the returns. And I've heard that from many people, even before Bernie was busted. I've read books that didn't mention his name, but talked about how nobody returns 1% a month consistently forever with no drawdowns. That's impossible. And Jim Simmons saw that and pulled the money from him. So he not only, had those returns with his firm, but he also smelled something funny at Bernie Madoff's fund.
Wasn't it Van Thorpe that in Market Wizards in his interview that, when he looked at Bernie Madoff's returns, like he was one of the first ones right off the bat to spot it?
I think you're right, Greg. I couldn't remember who it was. I thought it was a Market Wizards book, but I wasn't sure. But
it was the guy that wrote Beat the Dealer.
Yes, that's Thorpe, the one that created card counting.
Oh, there's Thorpe and Van Thorpe, and both of them are both of them are in the trading business. So yeah, Thorpe. It was Thorpe.
Yeah, I remember I read that before 2008. And the book was published before they got Bernie Madoff, I thought. In real time, I thought, I wonder who that is. And in 2008, I was like, I guess it was Bernie Madoff.
Yep. Yeah, he spotted it. He spotted it right away. Steve, why do you think they were successful at first with commodities, but they struggled with stocks?
I think it was the nature of the way they moved and the way the market makers were creating it. It's just different level of people try to figure out. The futures are mainly traded by professionals, while I think the stock market's the dentists and the doctors and the part-timers, and it works differently. That's the same thing I saw with commodities versus the stock market. I thought it was interesting when they had trouble with, was it the Canadian dollar, because the market makers kept giving them bad feels.
Right.
And couldn't get the system to work.
Right.
But yeah, it's different. The markets are so different. Like the trend following works so great in commodities, but I don't see trend following works as well the way it's done by the, Ed Secoda and the trend followers with the stock market. Also, the stock market has such a bullish bias. And I think the stock market can be pushed around more than commodities can by everything a CEO says, everything, the earnings announcements, and the nature of investors piling in, and the way mutual funds rotate into money the first month. I think stocks are just a different animal than commodities, is what gave them trouble, but they figured it out.
They did figure it out. I'm excited, Chris, for you to read it. I was in awe just reading it. Sometimes I see, because I've spent thousands of hours looking at charts, sometimes I see weird little things like, okay, the market's making a new high for today, but as soon as it ticked up to that new high, the VIX ticked up, which, should probably do the opposite, or just strange things. You see the market tick high, but as soon as it does, the leader of the day ticks down. And, I guess I'm just not smart enough at all. I see sometimes weird things, but I wouldn't know how to quantify it, back test it, program it, all that kind of stuff. But they did.
Yeah, I'm really excited to go through this one. I actually got that on my list on Amazon because Steve had just put out a Twitter post about, I think it was his 10 favorite trading books. And you know what this guy did? I put all 10 of them in my cart and checked out with them. And one of them was a Van Tharp book that you mentioned earlier, Trader Way to Financial Freedom. I'm looking at it right now on my bookshelf. I have got that one in yet. So it sounds like you guys have already read that one.
I don't know if I've read one by Van Tharp. I know that, but I don't know if it was that one. But it doesn't hurt to read a lot of trading books. I mean, I'll tell you what, I've read Steve's Moving Averages 101 before I actually got to be friends with Steve. I think I listened to it 8 or 9 times. And I'll tell you what, it made a huge impact on my trading because it was I had kind of a spot of my trading that needed help, and reading that book, I've read all of Steve's books. I mean, they're fantastic.
I want to talk about Steve like he's not listening for a minute, but but this guy, I don't know where he gets this stuff from. But first off, he writes it so easily to understand. I think that's why he's such a big seller and so widely regarded, right? He doesn't take these complicated topics and teach them in a complicated way. He takes a complicated topic and makes it as easy as understand as possible. And then I actually just started part of my well, I don't want to give too much away, but I'm going to be buying a bunch of Steve's New Trader, Rich Trader books. And that is actually one of my personal favorite trading books, was because like when I was reading through this, I was like, oh, just identifying with everything Steve was talking about and the way he wrote it. And it was so conversational, such a easy read, like a novel. And I was so blown away by that. So this Steve guy, if we ever get a chance to talk to him, he knows what he's talking about. Love to have him on the show sometime.
I agree. I can't say enough about. I mean, he's approachable. He's humble. He doesn't brag about winners. He's transparent with all of his trades. Steady. I mean, I owe a lot to Steve. I studied under Steve for a couple years, and I learned a tremendous amount. I mean, I can't thank the man enough. We should get him on.
I appreciate the kind words. Yeah, I spent so many years and decades studying and reading every book written and trading every system and every style and every time frame. It got to a point where, like, there's no reason for somebody to go through all this trouble and read all these hundreds of books and all these thousands of hours. There's got to be an easier way. Like, what would I write to myself? Had I just be able to send a book back to myself at the beginning and save myself all this time and trouble. Because it all boils down to very simple things, managing your psychology, trading a quantified system that has a winning edge consistently with the right position sizing, having diversified systems and signals and just trading it is, and the rest of so much of social media with Twitter, traders and finance is just so far away from that with all the predictions and egos and the people that are so sure the market's going to crash and they're so positive of all the silliness. And so funny when they just message me all day and night, all this silliness, and I just say, what's your position? Market's going to crash, this is not going to go on. Okay, what's your position? Where's your stop loss? What's your position size? That just always shuts them up because it's all just theory, and too many people are just messing around and playing around while other people really want to compound capital over a long period of time and change their life. That's what it's really all about.
Yeah, and social media is such a great place. Because of social media, all of us were able to connect like we have, and we live in 3 different parts of the country, and it's incredible what we can do, right? And how I can connect with people on my podcast, and Gregg can connect with people on his YouTube, and you can connect with people on your Twitter, and it is so toxic out there. I totally agree. and that's why I don't consume a lot of it. I'm not a scroller. I don't want to be in there, but it is really great to be able to connect with other people, right? Like being able to get someone like Mark Minervini on my podcast, like one of the greatest traders possibly ever, was like, sure, I'll come on your podcast just because I asked him a question on Twitter. It's like, holy cow, this is the greatest thing of all time. So yeah, I agree with you. There's a lot of knuckleheads out there, but it is pretty great what you can do with it.
Yeah, one of the things that got me started on social media was when I first went on Facebook. I think it was like 2010 maybe, and I went on Facebook and it recommended, most people get all their high school people they went to recommendations to be friends with, and I had recommendations for all the trading authors that I had known through Amazon, because I used to read and write reviews on all the trading books on Amazon. I was at one point the 151st most helpful reviewer on Amazon back around 2004, 2005.
Wow.
151st most helpful. And they put me in the Vine program, and all the authors, Alexander Elder would just send me all his books, and that's how I read so many books. Is they all sent me, and I had tons and tons of review copy of books. It was crazy, and I'd write reviews. It was like creating my own book reports, so I'd remember it. I can go back and look at my own reviews, and I just did it on Amazon, as a way to journal it all. And that's really where I got started meeting a lot of people, traders, new traders, authors, a lot of market wizards, and then a lot of them carried over. I saw their Facebook accounts. When I went on Facebook, it recommended all the email addresses I had. So then I connected with Covell and Van Tharp and Curtis Faith and a lot of Tom Basso, a lot of traders over the years. It's been fascinating, like you said, Chris, to be able to reach out and talk and chat and even get to know and be friends with a lot of my heroes in the trading world. It's been an amazing journey.
Steve, I've always meant to ask you this question in our Skype calls and lessons, but how did you put, you have a very distinct trading methodology, which I follow very closely. How did you put it together? Which books were most influential? And maybe it was a combination of books, but how did you put your approach together?
Yeah, it's an interesting question. It's sort of like you said, a confluence, like Covell's trend following, the principles of always going in the path of least resistance. That helped me understand, looking at all the backtesting was one of my best tools, was historical chart studies and backtesting, and focusing on the stock market as my market. And I saw the bullish bias of the stock market. So I, over the years, learned the hard way, having less and less short positions and less short side strategies, and to focus on the stock market, and then to get the position size right, where I would never lose more than 1% of my trading account if I was wrong. And then having how volatile each thing on my watch list was. I could trade. There was times I put 100% of my trading account in the SPY or the QQQ or indexes, because they're safe. They're already diversified by 500 or 100 things. So I could put all in on an index, but I have to maybe go 10% in on a volatile stock, and build it through backtesting, chart studies, the principles of trend following. Van Tharp, we talked about in his book. I think it's the How to Become Financially Independent Through Our Financial Freedom Through Trading. The marble game was another great one for me.
Oh, I remember that.
He shows, have everybody has the same win rate and how much percentage they're going to win or lose, and he'd draw a marble out, and whatever he picked, you can bet whatever you want to bet, position size, and he showed that everyone had the same trades, the same magnitude of wins or losses, but their position size completely determined their outcome. So that was another big key learning for me, is how I had such draw. I was very aggressive when I was young. I bet you can relate to that, Greg. Very aggressive, and just trading way too big, and having, I'd make great returns and have huge, especially during the .com craziness, but I'd also have big drawdowns. And I just learned I'd rather make a 20% return with a 5 or 10% drawdown than a 50% return with a 40 or 50% drawdown. And the risk of ruin, understanding, the probability that I was lucky to have come back from those drawdowns. So, a lot of things came into play for it all to come together, with psychology, risk, even the way you tie stress management into position sizing, and how the psychology interacts with the trading, the position sizing based on volatility, diversification. So, you have enough exposure to the right markets, but you don't have overexposure, and you have different stocks or different commodities that will perform differently with ETFs in different market environments. And what I needed as my goal for my return. So what I had to trade to get that return, and just having a small edge over and over. So it was a long journey of many decades, much like yours.
Do you think your approach will change in the future? Do you think it will be modified?
But what I've gotten less aggressive. Like the older I get, the less aggressive I get. I become happy with 12% returns, 15% returns. I'm completely happy with that. And if and people have to understand too, is like when you underperform buy and hold. There's years that the SPY's up 20% and you're up 15%, and you're frustrated, but you really had 1/4 the drawdown of buy and hold. And eventually they're taking on so much more risk to get their returns than a trader is. When you can just go to cash, in 2008 or during 20% corrections. But I'm trying to get to just a good correlation in my targets. I want to do about 15-20% a year with about 5% drawdown, and I much rather will give up returns than to create more risk and more drawdown. So I grow more conservative because I've achieved my goals, and now I just don't want to lose what I have. I'm very happy with what I have. I just have to keep having good, nice returns year over year without any big drawdowns. So I do get more conservative.
But other than being conservative, do you think any of your approaches will change?
I think like you've done with your overnight SPY trade. After reading the book, I am getting interested in more quantified, quantitative systems like that, where you find little edges and you just execute them with the position size. I've actually pondered taking the overnight SP 500 trade live next year. That is something I've looked at, and I've been working at what the position size would be, how much leverage, would I want to use SSO or UPRO for more leverage, what the drawdown would be on that, and how it performs under different market environments. So yeah, I've thought about using quantified thing. Even Chris, getting into some options trades and just going back into some options. I haven't traded those in years. I used to really have fun, too much fun trading to a fault. But actually looking at options things to limit risk and go back into in the money calls, or just finding something though that just repeats where you must make steady money. Another fascinating book I read years ago was short straddles in the SPY backtest over the history of the SPY is profitable even through using the SP 500 through the 1987 crash. Using the SP 500 straddles does play out over the long term for profitability. I thought about using that on a weekly basis and selling some kind of premium. Of course, I would want to do, hedge it with wings out of the money options than to just have open risk. I don't think I'd ever do that. But just looking at, edges, sort of like from the book, quantified edges that you just play over and over. It seems like Renaissance Technologies almost built itself its own casino. And that's a pretty cool thing. If you know that you have an edge, you're just executing it over and over again and letting it play out.
Yeah.
Steve, on that topic, when I was looking at, implementing Gregg's strategy there, my first thought was going to options because, let's say you sold an out of the money put spread. You're going to get that theta decay from one day to the next. And I mean, you would compound that with also the delta move. And I was like, hey, you know what? That actually might be something there, right? Take a little tiny position, a little spread, and just repeat it overnight every day. So that was what was going through my mind, was you get the data and the theta, the delta and the theta.
Yeah, I also thought
moving together.
I also thought about selling premium at the open every morning, since the market doesn't tend to move intraday over the long term. Selling premium right at the open every day, and then closing it out every day at the close.
That makes sense.
Selling put, seeing what size you got to do to make it meaningful. Sell a put as the market, or sell a call because the market usually doesn't crash up. Usually the risk is more in puts than in calls, because you can have crash downs, but you rarely have crash ups. So it might be an edge on selling a call every morning and then close. I remember back I used to day trade weekly options. And the pins, especially on Friday, the pin action around certain price points were so accurate for so long, thinking, man, you could make a lot of money just selling. Even if you went in Friday and sold a bunch of calls that morning and closed them out that evening before the market closed So that's probably a system in there.
Yeah. Makes sense. That's the great thing about trading. You can be as creative as you want.
Yeah, as long as you're just looking for edges.
Yeah, as long as you're looking for edges. I think traders just need to get back to basics. There's so many approaches, and they seem complex, but as Steve taught me, I mean, people lose money because they position size too large, and they basically stay on the wrong side of the moving average. I mean, that's back to basics. Position size correctly, stay on the right side of your moving average, and if you're wrong, just get out. But I think people need to get back to basics.
Yeah,
Well, Greg, on that topic, this is something that I learned and had to overcome, and it's still occasionally that little voice in the back of my head. It's like, well, are you sure you want to do that? But the idea of, and really, I think Steve said it. It's like, the only way you blow out as a trader is by having too many losing positions, and you have too many losing positions because you're not closing them when you're supposed to. Yeah. How do you guys look at that and like mentally grasp, okay, I can move on with this, even though it's a loser? Because I know that like from a new trader's perspective, they're like, I'm going to hold on to this. It's going to come back. And, at the end of the day, they may be potentially tens or hundreds of points away, and they're still like, it'll come back.
Hope. What are your thoughts on that, Steve?
Yeah, it's built in human physiology. I think they've shown psychologically people have multiple times more pain with losses than they have feeling good about wins. So people naturally don't want to lock in a loss. They want, like you said, jump to hope and want it to come back to even. It feels better to get back to even than admit they're wrong. Part of ego comes into that. And when they have a winner, they want to get those profits off as quickly as possible and lock them in, and they don't want to let it run. It's funny. People are physiologically built to let losers run, hoping they'll come back, and want to lock in profits quickly so they can have the win of saying, I made money, I made this profit. When in reality, they need a reason. If the market has proven that you have a high probability of being wrong after entering, it's much smarter to keep the loss small now and get out instead of risking a larger loss. And if you have a winner, there's no reason to get out. It's not overbought. It hasn't gone too far too fast. It could go much, much farther. You need the big winners to offset the losers. And what people normally do that make them unprofitable, why 90% of people don't make money, is they have big losers and small winners.
Yeah, and I tried to explain that to my brother-in-law one day because he wants to trade. And I was like, the hardest part of trading to really just grasp and get over is letting your winners run, but cutting your losers short. Because it sounds so easy. It sounds like, yeah, of course, that's what everybody does, right? But in reality, like, it's the hardest thing because you're like, oh, but I got these profits, so I'm gonna take them real quick. And then the losers, it's like, I'll just, in options terms, I'll just roll it to next month. It'll come back. I'll roll it to next month. It'll come back. And I know that there are trading mentors out there that preach this philosophy where, you take your winners as soon as you have them, and then you roll your losers month to month, and eventually they'll come back. And I have found through my own trading that that's just, it's a recipe for disaster. And I've lived it. Let me tell you, I've lived the recipe for disaster trading that way. So yeah, it's crazy the way, it seems so intuitive, but yet is difficult to do.
And profitable trading is simply the size of your wins versus the size of your losses, along with your winning percentage. You can be profitable with a lower winning percentage, and you can be unprofitable with a high winning percentage. Mm-hmm. The most important thing is the size of your wins versus your losses. And that's what profitable trading is. Everything else is just opinions and theories. That's the math is what that is.
I've read, I can't remember where I read it, but it did make sense. Chris was just saying that, people want to take profits quickly and they want to let their losers run. So, from an evolutionary standpoint and a psychological standpoint, you're up against two big issues. And the first issue from like an evolutionary standpoint is when we were, when we were doing long time ago, right? When man was just evolving, we would plant our crops, but we would always be scared that we'd have a frost come in. And if the frost came in, then we have no food for the winter. So as soon as you have a little sprouts, as soon as your crops starts sprouting a little bit coming up, they would go out and hurry and take the crop in so they had something. So when it comes to trading, when we have from an evolutionary standpoint, when we have a gain, that kind of is in our DNA to take it while it's there. You see what I mean? Mm-hmm. Referencing back to crops. And then, of course, on the other side, we have this ego problem where if we're wrong, we don't want to be wrong. It hurts our ego, so we want to stay in that position. I mean, one thing that might be helpful, I learned this from Larry Williams, taught me this, but he says, I go into every single trade thinking it's going to be a loser. And if I think it's going to be a loser, then if it becomes a loser, then it doesn't hurt my ego. I was right on my prediction, and it's easy for me to get out. And it sounds a little negative, but I'm scared of every single trade, and I assume it's going to be a loser, so that if it is a loser, I quickly get out, my ego's intact, and when it all comes out in the wash, it's good that I get out of a loser quickly, instead of thinking, oh, this is going to be a winner, and then it starts going against me, and then I want to keep it. So anyway, maybe a little hack for people out there too. If you take that mindset, it's worked for me.
Yeah.
Oh, that's really interesting. And in fact, I would almost like hate to do that, because I would be like, oh, this is going to be a self-fulfilling prophecy. So if every trade I put on is going to be a loser, then I'm just going to be losing all the time, and then Gregg doesn't know what he's talking about, and screw this trading thing.
Try it. I mean, if you have a problem getting out of losing trades, but it really has helped me. I got it. I mean, it's just a weird little mindset. I go, this trade's probably going to be a loser. And if it is, aha, I was right. And it's very easy to get out, and it keeps me on the track of keeping my losses small.
I think Paul Tudor Jones had a quote just like that. Paul Tudor Jones said he went in every morning expecting every trade he had to be a loser. So he already set his mind like that. It's a risk to start off, and he's been one of the greatest consistent traders for the last 30 years. I don't think his flagship funds have had a losing year in 30 years.
Wow.
And had double-digit returns until recently. I think recently he's underperformed like so many. And Ray Dalio's underperformed the way the markets have been really going beyond historical norms the last few years.
Right.
But I think that was one of Jim Simmons' firm's edges was, he hired the mathematicians and the computer scientists and the programmers to do purely mathematical trades, and didn't have emotions and feelings and egos involved. They just simply created systems and let the systems run, and then made adjustments to the systems and used machine learning to adjust to the market as it evolved. So I think that's one of his major edges. There's no emotions and egos and stomach aches and headaches going on when he's executing thousands of trades through the computers every day at Renaissance.
Yeah.
One thing on that topic, the way that I'm trading now, I've got my model that I built up, and it doesn't even allow me to keep the trades on if they're going the wrong way. Like in the past, if something's moving, with the 520 crossover this direction, and then it crosses back the other direction. Now my system's like, you know what? That's probably a trade for the other way. Then you're holding it, and it's probably a good time to get out now. So, there was this guy I learned the moving average crossovers from called Steve Burns. Like I say, he knows what he's talking about. I don't remember which one of Steve's books it was, but I think it was Moving Average Crossovers That Beat, Buy, and Hold was one of the first ones I read. And I was like, wow, this is really interesting. And then, in fact, Gregg, you mentioned on one of your episodes, and I picked it up, and you said it so casually without, I didn't even think, anyone else noticed it, but you were like, the moving average crossover system is designed to have small losses and big wins. And I was like, whoa, green, bulb went off in my head. Like, wow, that is really brilliant, because it's true. So yeah, that's,
I learned that from Steve, by the way. That wasn't me.
This Steve guy, I tell you.
Yeah, I learned that from many different people. Many different people use the moving averages in different contexts. From the turtle traders, Jerry Parker talked about them. I think one of the most legendary ones, Marty Schwartz, day trading the S&P 500 futures back in maybe the late 80s. He used the 5-day, the 10-day EMA as his green light, red light signal for day trading, and he was making 20% a month from from day trading the futures, which is is a Herculean task. Very few people ever achieve that consistently.
Amazing.
And so a lot of that I picked up from the William J. O'Neill Company. So I've learned pieces of moving averages from probably 10 different really big sources, including Paul Tudor Jones, and I've tried to integrate that all together into systems and actually back test all the numbers. But like you said, it's funny how a moving average is just a filter of a trend. It captures, it shows you what direction the market's moving in. It also is a risk management tool where if you closes below that, you get out. But if it's trending, it's a way to quantify and measure a trend and stay with it. So it's fascinating how they're tools for risk reward ratios.
Yeah. Yep, for sure. For sure.
Well, guys, we have reached the end of our time today. That was 45 minutes. That felt like 10.
It did. It totally did.
I feel like we could do this for hours. So we're going to have to do this again. I don't know when the next one will be, but I want to shoot for this being at least monthly, if not more often than that. Because I know, the audience out there for all three of our respective audiences is going to get a huge thrill from this, being able to listen and hear these insights, that they wouldn't get just from like a normal interview type situation, but being able to talk casually and what we've learned and how we're implementing it and things like that. So guys, this was really, really great. Steve, where would you like people to reach out to you at going forward?
Hey, I think just newtraderu.com. It's the letter U, newtraderu.com. That's where you can connect with me on any platform from there.
Perfect. And Gregg, where can people find you at?
They can find me on YouTube. My channel is called Gossett Trading and Mentoring Live, and during the last hour of each day, the last hour of the market of each day, I trade live. I explain what I'm doing, what my current positions are, how I'm managing them. I look for new positions and so forth. And a lot of what we just talked about here is my approach. So if they'd like to tune in, it'd be great to have them there.
Awesome. And for everyone else, you can reach out to me. My website is 10minutestocktrader.com. That's 10minute stocktrader.com. And also, I'd love for you to check out my podcast. It's called the How to Trade Stocks and Options podcast. I put that on 3 days a week, and it's not quite as much as Gregg, but I'm trying because Gregg is up there every single day. So listen, guys, this has been awesome. I cannot wait to do the next Traders Roundtable, and I'm so thrilled that we're able to connect and to share this with the audience out there. So thank you so much for allowing this to happen.
I'm glad you put this together, Chris. I always enjoy talking to you guys, even if we were just talking amongst ourselves.
Yeah, thank you, Chris. This was great, and I appreciate the invite.
My pleasure. And thank you guys for tuning in to our first Traders Roundtable. You know what? Be sure to subscribe to all three of our platforms, and we'll see you on the next episode. Well, guys, that really was awesome. I was just sitting back taking notes, and yeah, this was good. And it just felt like no time at all. So I can't wait to do it again.
That did feel like 10 minutes. Really did feel like 10 minutes.
Yeah, I enjoyed it. I would just talk to you guys just as friends. So this works out great for me.
Yeah, that's what I was thinking. Well, perfect. Hey, you guys have a great rest of the day and a great weekend. And I'll shoot you over the file. And I'm going to put it up for next Friday's podcast. So you guys do with it whatever you see fit. And let me know if you need any help with the editing or anything. I'd be glad to help out.
All right. Thanks a lot, Chris.
Okay. Thanks. Thanks, Chris. Thanks, Steve. Good seeing you, or good speaking with you.
Great talking to you, Gregg.
Okay.
See you guys later.
Bye-bye. Thanks again.